Here we go. I'm going to cough first. Welcome everybody to the February 2023 market update. I'm Cindy Bishop with Cindy Bishop Worldwide. The topic for today is our monthly market update. I don't know if you do, but I know I look forward to it because Jolene is the whiz kid on mortgage information and interest rates, etc. This update has become very popular and useful for agents as they navigate through the real estate business with the ups and downs of this business. This market update is very important for all of us because it anchors where the real estate market is currently with mortgage updates and interest rates. This information is crucial for you as real estate agents, but especially valued due to the excellence of our speaker. Our speaker, Jolene Moore, is a top producing lender. Her knowledge of market intricacies as well as her attention to detail cause her to be one of the best mortgage finance authorities in your market today. Jolene has an abundance of experience and a keen ability in the real estate lending field. She is not only a top producing lender nationwide, she is also a vice president and senior home loan consultant with Main Street Home Loans in Fairfax. She is also a well-respected and sought after trainer with us, Cindy Bishop Worldwide. So please welcome Jolene Moore, your presenter today.
Hello, thank you, Cindy. Thanks, everyone. And thank you all. I always want to point out those that are on camera. I appreciate it. I like looking at faces, so appreciate all of you guys doing that. February 7th, so we're a month into the year. So lots of stuff happening. So I'm going to jump in and kind of give you an updates. So the first is interest rates. It's always the most, popular topic. So Friday, rates, we've talked about, we've hit our peak as of probably October, where we're in the 7.5 range or so, and then we've been improving. It's been, as I keep saying to clients, it's not been a straight downward trend. We've had, ups and downs, but for the most part, we've improved, into the high 5s, low 6s, and interest rate wise. Friday, job reports came out. So partly why we've had started to improve, and I've mentioned this in previous updates, is that inflation was starting to, it felt like what the feds were doing by raising their interest rates had started to have impact on the economy, and it was starting to improve regarding inflation. And so that was helping us start to increase interest rates. So when the job reports came out on Friday, they came out on 2-3, they increased by 3 times more than what was expected, which means that part of what the feds were doing was there was too many jobs available, basically, and that what they were trying to do was increase, decrease the amount of jobs potentially available, because that's going to help with inflation. And by the job reports coming out so strong, that makes the feds believe that what they're doing is not having the impact that they need to, or is not strong enough. So many Fed members reacted to that they believe they need to increase their rate at a higher pace, because when they met last week, due to inflation numbers that had come out and things were looking positive in that regard, they only increased their rate by 0.25%. They had been raising them by 3.75% and 0.5% over the past year. Because you can see prime rate right now is 7.75. So if you have a home equity line of credit, the rate is 7.75 plus whatever margin may be connected to that home equity line of credit. Versus a year ago, that rate was 3.25. So the feds have raised their rate 4.25 or 4.5% over the past year, right? So we were feeling, and the bond market was feeling, which is based on, what controls long-term interest rates, as that the feds, based on the inflation numbers that were coming out, is the feds were not going to have to continue to raise their rate at such a fast pace as they had over the past year. And that was where we are starting to see some improvement in our rates. Like we've talked about, what the feds do doesn't have a direct correlation on our interest rates, but it has an impact, and it's usually built into the market before it even happens, because the market is anticipating, based on the economic reports that are coming out, of what the feds are going to do. So because of these very super strong job reports, there's a possibility when the feds meet next, and Fed Chair Powell is actually speaking today. I think he was supposed to start at 12:40, and I didn't see the notes from it yet. So we'll see what he says. So what he says may have some impact on the market as well. And we might start to see some movement if he, chimes in at what some of the other Fed presidents are saying, is that they may need to increase the rates more and at a faster pace. So we'll see what he has to say. But because of that, we saw our rates move up yesterday. Now, not significantly, but it did move up. So what and I think the important thing to come away from this is that we're not going to see a straight line. The rates are not going to go, to 5%, 5.5% like that. We are going to see some volatility along the way. Now, there are some that believe this job reports is not 100% in reality, and that we may see some pullback from that in the future, meaning there's, as you guys have seen, there's a lot of layoffs. There's a lot of layoffs in our industry and mine. There's in technology, you've seen a lot of layoffs. So the amount of job growth doesn't really correlate with what we've also been seeing. So there are some experts that believe we'll see some adjustments to that, and that the bond market, I think, is believing and realizing that job number is probably not as good as it may look like, because if they did feel like it was really truly in line, we probably would have saw the rates in the market reacting even stronger. So we'll see. The future is what's going to show us that, but it's some things to keep in mind, and obviously to have conversations with your clients. Anyone have any questions on interest rates? And I forgot to say this, I love when you unmute yourself and ask questions. You can also put it in the chat. I have that open. So any questions you might have, feel free to speak up, because I love interaction, and, we all learn from each other when you guys ask questions. Anything on interest rates? All right, well, so the next thing I'm going to talk about is there was a headline on CNN that said mortgage rates dropped to the 5% range. I had multiple clients call me last week and say, we locked in and the rates are now 5%. Can we relock? Here's what the truth is. All right, so this headline right here, mortgage rates dropped to 5% range for the first time since September. If you scroll into it, it's 5.99, which is not 5%, right? That's 6 if we're rounding up. But all clients don't read that, right? So they're going to, and you can see the rate started at 6.21. There's no way we're going from 6.21 down to 5 within a couple days. Like, for instance, I locked a client on Tuesday at 6.125. He called me Thursday after this information came out. You can see it was published on Thursday, February 2nd, and said rates are in 5%. Now can I relock? So that's, again, something to keep in mind for yourselves. I think it's great that you are here, because this is educating yourself so you can give truth to your clients. Because unfortunately, the media, says a lot of things that make it look, a different way than what the reality is. So it's really important to try to keep a pulse on what the market's doing so that you understand, how to educate your clients. Heather just asked, what are rates today? The rates are in the 6s. They're low 6s, right? Because of the market move up we saw last week or yesterday, because of those job reports, we're probably back to 6 1/8, 6 1/4, somewhere around in that range. So the reality is with points, could you get into the high 5s? Yes. But the without points, we're still in the 6 range for most products. Now, there are some that you may be able, like an ARM and things like that, and we'll get into that. But again, that's probably going to take points as well. And then also a rent versus buy scenario. I wanted to just show you guys that I put this together for a client as well, because we obviously have a lot of clients dealing with affordability and challenges there. And, a lot of clients saying, I'm just going to keep renting. And this was a scenario that I put together for a client. It was based on a particular property at $550 versus what she was paying for rent of $2,100. And it shows, what with the annual rent increase, the cash flow was definitely meaning she's paying more a month for the mortgage versus she is for renting. But big picture, when they look at creating wealth, which is what real estate is also about, you can see here that she has an appreciation gain. We averaged 4.65% a year. So over that, this is over a 9-year period, she had almost $278,000 in appreciation. They would have paid down their mortgage as well by $74,000 over that same time period. They can have tax benefit. This also takes into consideration the cost to sell. And then it shows over a 7-year period, they would have gained $174,000 in net in worth based on the appreciation versus even paying more on their mortgage versus the rent. So again, this is something, if you guys are interested, reach out to me that we can. And then what I did is I created a video And I explained this and walked this through with the client so they could understand and see what the possibilities are for them. And again, we can figure out, okay, how long do they see themselves staying in the home? You know, what those different situations look like. This was based on 5% down. If they put more money down, there's all kinds of things like that, so that it can help you educate them and help them see the benefit of owning the home beyond just the monthly payment. So again, if you got, does anyone have any questions on this? And Lisa just said, can you email that to us and I will send this to you all. Anyone have any questions? So if you do have anyone that, like I said, that this could apply to, reach out to me and we can help them, you know, kind of understand that benefit. All right, so back to some market numbers. You know, units sold for, this was the end of the year for 2022. Units sold were down 28%. One of the things I wanted to compare and look at, okay, last year we were at 18,680 units sold. This was in Northern Virginia, Realtor Association numbers where I got this. And then versus 2019, we sold 21,176. So if you look at that, we were down 12%. So, you know, I think as we all know, 21 was a very unique year. Are we going to repeat those numbers? I don't know. But I'd say 2019 was probably more of the most recent regular year. So that's why I wanted to show, if you look at that, you know, we were only down 12%, which is not as significant as it feels at 28. Average sales prices ended up 13% year over year. So again, our values still ended at the end of the year being higher than where we started. The cash sales in December, which I thought was interesting, and again, probably because rates had increased, we're up to 21%. That's the highest I had seen all year because I track this every month. I think the highest we'd been at before that was like 15, 16%. So it jumped up a decent amount in December up to 21%. So we'll see as rates now started to improve, if we will see those cash sales start to decrease. But the reality is I have a lot of clients and agents that say to me, we went up against cash and we lost. If you look at it, if only 20%, 1% of those transactions were done in cash, we're not going up against it as much or as often as we think. So something to keep in mind. And then VA loans were down to 9%. And it kind of is there for the past couple of months. So hopefully we'll see that move up a little bit as well. All right, so some lending information that I wanted to share with you. The soft pull credit. So I just did a video on this. I can't remember if it's gone out yet or not. If you hasn't, you guys will be receiving it. What this means is that we have clients and we have, you know, for many years where they're like, I don't want to, you know, fill out a pre-approval application because I don't want to have my credit pulled. And so we talked to them about the hard inquiry and how it can have minimal impact, you know, all kind of talk and explain all of that. Well, now what's become much more accessible and available is what's called a soft pull. So a soft pull credit is where we are running one credit bureau. So we don't run all three bureaus. We run one bureau and we get the liabilities and credit score based on that bureau. And it does not show as an inquiry on the credit report. So there are scenarios where I'm doing this where if the client is not, you know, going to be purchasing for the several months and they just want to help get educated and figure out what it's going to look like, we can do this to help prepare them and run loan scenarios and everything so that they're, you know how to, what to work on over the next few months. It also may be like we said, if they're worried about the hard inquiry and we want to just be able to get their information to provide some scenarios for them. But what I will tell you is if we run their credit and the credit score is marginal for programs that we're looking at, their debt to income ratios are really tight. Anything like that, we're going to request that we do a full credit pull, do a hard credit and pull all three bureaus, because I do not want anyone to go into a situation where we have not done all of our due diligence and they get into a contract and now have issues. So that's just something to keep in mind if you're having conversations with clients that that's a possibility now. Cash out refinance scenario seasoning. Obviously, as rates might improve, we might start to see a little bit of more opportunities for people looking to refinance and potentially take out some cash. So one of the things that has happened in, you know, the profession with guidelines is as when the market tightens up a little bit, we see prices, you know, decreasing. then Fannie and Freddie will start to make some changes. So one of the things that they changed is now you have to have the loan for at least 12 months before you can use a new value. So there's some things, meaning that we might, see some tightening in that regard. So it used, for quite a while, it's been where if, as soon as they buy a house, they could look at refinancing a few months from later or 6 months later or whatever, and be able to pull out cash. Now there's some seasoning and time period that they have to actually have the house before they'd be able to do anything. Something that's come about for us recently is we have some 5 and 10 year or 7 and 10 year ARMs conforming, which means it's really priced very well for loans that are below 726. 726,000 and with as little as 5% down. So most of the ARMs that we've seen in the market have been needing 20% down and all of that. So it's really nice to have some ARM products that we can actually do with lower down payments for clients. So something again to keep in mind. DSCR, I've mentioned it in the past, but I think again, this might come up a little bit more frequently now as we're seeing rates improve on that program as well. And what that is it's a loan that's for investment properties only. And it is for clients where they're purchasing a home and they may have some trouble qualifying based on the debt to income ratios. This loan allows us to just take, as long as the potential rent income for the property exceeds the mortgage payment, then they qualify and there's no debt to income ratio guidelines. The only thing we have to verify is their assets. So they do still have to have the assets and we still have to verify that. But I have a situation with a client who's looking at buying a 4-unit property. She's self-employed. She writes everything off. It's going to be really hard for her to qualify. This is a great loan for her to be able to buy that property, use the potential rent from that, those 4 units in the property and help her qualify for the loan. So again, the rates are going to be a little bit higher because it's a, outside the box program. So it's just something to keep in mind that we could, help buyers when they're looking at buying investment properties. VHDA Spark. I just wanted to bring this up because again, I think a lot of my clients and a lot of the new people I'm talking to this year are first-time home buyers. So first-time home buyers, I'm sure you all know about VHDA. So for first-time home buyers, the income, guidelines for, whether or not they have, they want to get the grant or they're going to do just the traditional loan, maybe get a second loan to cover to where it makes it 100% financing. There's also a Spark program, and it is dependent on the county and what that will look like. But the Spark program you can do in conjunction with VHDA, and that can potentially give someone up to 1% lower in interest rate. So let's say the VHDA rate is 6.5, and if we do Spark, it could take it down to 5.5. Arlington County is a great county. It's super easy to do it with. There, Prince William County, you have to go through their first-time home buyer program within Prince William County government. So it takes a little bit more due diligence to do things up front, but we can help them walk through what they need to, depending on where they're looking to buy. And what they need to do to prepare to be able to use the Spark program. So again, they have to meet the income guidelines and the sales price and all of that, but it's a great program that can help them qualify potentially for a little bit more by doing that program. And then new pricing for rates for certain credit scores and loan to values. That's what LTV stands for, is loan to value, meaning how much they're putting down, which is going into effect in May. So just something to keep in mind when Fannie and Freddie say something's going into effect in May 1st, we as lenders have to put it into effect earlier than that because it means any loan that's delivered to them. So that it usually takes 2-3 weeks for us for a loan to close and for it to be able to get delivered to Fannie or Freddie. So these are probably going to start going into effect sometime in April is what I would expect. And so, what they're trying to do is trying to help some of the lower scores, higher loan to values are actually getting a little bit better in interest rates. And then those that have, if your debt to income ratio goes over 43%, your rate could be a little bit higher, which has never been the case. If you, have a certain credit score and then a certain loan to value, it's kind of all over the place. But what it means is some people that might have good credit could see, in rates a little bit higher, or there's going to be a bigger gap between like 740, 760, 780. They do it in 20-point increments. So there's all kinds of things that that's going to go into effect, that's going to have impact that we're going to be aware of. Now, the Mortgage Banker Association is trying to get some of this removed, especially the debt to income ratio changes that they're putting into effect, because there's not a lot of validity to why that they would be doing that. And it's actually potentially hurting the market by putting these restrictions in place and creating higher interest rates. So we'll see what ends up going into effect as we get a little bit closer, because I know there's some lobbying and things that are trying to be done to change some of these changes that they put into place. So, all right, so I see some questions. So let's go back here. Please email that. Yep, I will. And then what are the rates on ARMs? They're in the low fives. Again, it's going to depend on scenarios, loan to values, credit scores, all that kind of stuff. But I've locked in a rate with our client recently at 5.25 with 1 point on a 10-year ARM. So there, again, it's just going to depend. And with rates for Fairfax County, I mean, for VHDA, that also is a lot dependent on the people's credit score and what that ultimate rate is going to be. I would say for the most part, VHDA is probably at 6.5, 6.625, somewhere like that. And then Fairfax County, I believe you can just, there's another organization that we have connected. I think it's called National Alliance. I can't remember the full name, but that's the way we'd probably do Fairfax County, is connecting with that. The good thing is it's the new year, so a lot of these should have got new funds, because some of the organizations we were working with last year had run out of funds. So that's something to keep in mind too, is this is based on availability of funds for the Spark. There are great first-time homebuyer programs with Maryland too. We've done those. We did one where they paid off their student loans with the program. Lots of different programs with Maryland. They have more than we do. So we also work with Maryland first-time homebuyer programs. And then, are we inching back to the financing 2000s and seeing it for no income and no problem? No, I would say no. You know, she was asking, are we going back? No, I mean, I would say there are more products available right now than we've had for quite a while, but they still have guidelines in place. They still are checking credit scores. The DSCR is based on, you're going to have to put 25% down at least. So there's value there. So if the house, you know, if you don't make the payment, they're going to be able to still make back their money, because there's going to be equity in the home. There's bank statement programs, but again, those are only for self-employed borrowers. And we're actually looking at the bank statement to verify that they have the income coming in. So there's a lot more restrictions and guidelines when you see, and like I said, you guys are looking at headlines, just like we just looked at that headline that said rates are in 5%. When you get down to the reality of it, there's going to be guidelines, there's going to be things that you're going to follow. The majority. Now, is there outliers out in the market that might be doing some crazy things? There is, but it's not majority at all. I will tell you that. Also, any appraisal issues lately? I have not seen any appraisal issues, but that takes me to my next slide. One of the things that we're talking about again, because I'm sure you guys saw over the past 3 weeks, the market shifted, and we're now, a lot of my clients are facing multiple offers and escalation clauses and waiving appraisals and all that kind of fun stuff. So like this morning, I had a client making an offer. She's going above, not too much over, I think versus what she thinks, the agent thinks versus what it could appraise for. What she's offering is probably a $7,000 gap. So it was a condo, so it's not a huge amount. But what we talked about is, what does that mean? Okay, so if you're offering this and your house, the house only appraises for that, what do you have? How can you make up the difference? So if you're putting the minimum down, that's when it becomes challenging and you're going to have to come up with extra cash. But I did a video, and I think I sent this out last week, explaining this. And it's basically that, there's a scenario where you were putting 10% down, the appraisal came in low. And so we had an appraisal gap, I'd say, I think it was 20,000. So it really only changed the payment by like $34 because the mortgage insurance went up slightly. But they didn't have to change their cash to close, because we basically went from 10% down to like 6% down. So we were able to use the money that they had originally planned to use for the purchase and reallocated it some to, make up the difference between the appraisal and sales price, and then the rest towards the down payment of the loan. So there's definitely strategies that we've helped clients feel comfortable in waiving appraisal contingencies and make them understand that they're not putting themselves at risk substantially. Now, again, we're relying on you all to, to give us an idea of what you think the house would praise for. So, we're working together to help that client figure out exactly what those scenarios might look like. So far, we haven't had substantial, any issues with appraisals, but again, we'll see as time goes along. Escrowing for repairs, just again, if you ever have a situation where you're looking to escrow for a repair, reach out to the lender, because don't assume that it's going to be allowed, because depending on the product, depending on how much the repairs are for, could impact whether or not it's going to be a possibility. So just make sure you reach out as soon as you know anything. In regards to the market, I wanted to bring up that, quick closes. We're obviously going to start to see that again if the market continues on this pace and that we are seeing these multiple offers. So if you have a need for that, we have the ability to do it and, be able to make things happen quickly for you. This was a question I've gotten a decent amount of times over the years and just recently as well, as, say someone has been unemployed or out of the job market for a period of time and they've now gone back to work. How long do they have to be back to work before we can use their income? A lot of that depends on how big the gap was. If the gap of unemployment was greater than 6 months, then they're going to normally have to be on the job back to the new job at least 6 months if it's a salaried position. If it's an hourly position and the hours fluctuate, it could be a whole year that they may need to be back. So it just depends on the scenario. So there's no very simple answer there. It's always going to depend on what that particular client's situation is. So if you have any questions in that, reach out to me and we can talk through it to help you and help the client understand what the possibilities are. The other thing, that we do, and, I just want to kind of bring it to your attention as well, is when you have two borrowers, does it always make sense to have both borrowers on the loan? Does it make sense to do it with just one? So I had a conversation with a client last night, first-time home buyer. They want to look at potentially using the VHDA loan. Well, as we talked about, VHDA has income restrictions. They together make over $250,000. So we're going to have to probably do the loan in just one of their names. So then I told them that we're going to look to see which one makes the best sense. They have different income levels, but one has more debt than the other. So we're going to analyze based on the full picture of each borrower of which would make sense and help them the most with, purchasing power, with monthly payment, all of that. So you want to just make sure that you're working with someone who does all of that due diligence, because, there's a lot of clients that I've talked to that have worked, talked to big banks or credit unions. They are basically just taking the client's information and spitting out information, pre-approval letter. They're not always doing the due diligence and really researching and figure out what works best for the client and how you can help them be the most successful. So just know that that's something that we're doing. And if you have anyone, that needs that guidance, let us know. First-time home buyers, I think, are out with a vengeance. I'm assuming you guys are probably experiencing that as well. We're probably not going to see a lot of move-up buyers because they have really low interest rates right now. So a lot of them are going to be like, I'm not leaving my rate. So I think a big part of the market is going to be first-time home buyers, which I am seeing. Like Cindy said, we're doing a first-time home buyer class next week for CE credit, which I think is great timing. But also just know that, it's something, I think it's all about educating for first-time home buyers. We have a home buyer's guide, and if you guys don't have one, I think you should create one. It's a great way to help educate your clients. We do, consultations with the clients. So there's all kinds of things that we're putting into place. We have videos that explain different aspects of the process. So whatever we can do to help educate them and help them feel comfortable and confident and not too anxious is really what our goal is. So I think it's something that you guys can all think about of how can you be implementing all of that. If you're social media, are you educating on social media? Are you, providing that information that could be super valuable to bring in those potential clients? So I think first-time home buyers is going to be a big part of our market this year. And then Robin asks, when is escrow for repairs ever allowed? Actually, it is allowed at times. It just depends. Like if it's over $5,000, that's when it becomes a little challenging for escrowing for repairs. If it's under $5,000, there's also times where we've had it. What we'd prefer is, pay an invoice to a contractor or things like that. So there's little ways that we can try to, handle it to where it doesn't even have to be an escrow, but still getting paid out to do the repairs. So there's things that we've kind of worked through to make that happen. Anyone have any questions on this information? What are you guys all seeing in the market? Are you seeing 2-3 weeks ago? Are you seeing multiple offers? Did you see it pick up wherever you are? Because I know you guys are all in different markets. So I'd love to hear, what each of you might be experiencing if you're not like Fairfax County where I am. Robin, yes, multiple strong offers. And are you seeing these multiple offers on well-priced homes that look great? Are you seeing it on homes that need work, that need some updating? Because I know what I'm seeing, but I'd love again to see what you guys are seeing. Multiple offers are move-in ready homes. Yep.
From Jolene, for me, it's been move-in ready for the buyers I'm working with right now. But I have been surprised to see some homes in my neighborhood sell for list price when I think they need a lot of work. And I think those prices are ambitious, but they are selling for that.
Okay. They didn't go over, but they did at least get the sales price, the list price.
Well, one went over 20,000, but I don't know how many offers they had because my client did bid on it. The one buyer I've got active right now lost her first place. There were 5 offers total. She won on the second, didn't waive anything, but very competitive, free rent back, crossing out the broom clean and free of trash and debris. Appraisal gap, you 20% down, you name it. It's a good time to be a seller again, I think.
Yeah. And the appraisal gap on the contract, that's new, right? Because I just saw that on one of our contracts.
The language is new this year because so many agents were kind of writing their own and playing attorney and not getting it right. And some of those things led to problems, actually.
Yeah. And how do you guys feel? Like, do you think that's going to be helpful?
I think it makes it easier.
Yeah. That's what I was looking at. I was like, oh, that's good. I hadn't seen it. So I'm glad about that. And Maya, on your property, you said you had the open house. Was that a move-in ready home that you had the 8 offers and 4 waiving everything?
Yes, that is one property that we actually listed for a client, but before we listed, they gave us a budget and our team renovated it for them and we listed it. So it was fully renovated and it kind of flew off the shelf.
Okay. And, I know at some agents had, some strategies was if let's say the market price was $850, but you might have listed it for $830, kind of going a little under market and then hoping for, escalations and things like that. How do you guys feel like you're pricing right now in the market? Are you pricing at market and then going over, or are you going a little under market and then going over? Does that make sense? All right. Anyone have any, again, Maya, what do you
Sorry, my lights turned off in my office and I got a little scared.
That's okay.
We priced it a tiny bit lower just because we wanted to see, the activity that was gonna, come from it, but we actually priced it perfect.
Okay.
And we priced it at 400 and got 415, waiving everything.
Okay.
I did put an offer yesterday on another property with another client and we were, I guess, top 4 offers and they got 6, but we were beat because they waived everything as well. So it's definitely coming back. The market's getting a little bit hotter. I have a few properties gonna list soon. I'm kind of pushing them to hurry up and finish whatever little things they want to get done in the house because I want to get it on the market and kind of take advantage.
Right. Well, and that's where I'm curious, like, as we see, like Robin, you were saying, because I'm hoping that we might have more of a balanced market in the sense the ones that are move-in ready are going over, but the ones that still need some work that clients might have opportunities on and not have to do all the waiving and escalating. So I guess we'll see, how that works out, because I've had some clients in that scenario, but that was, the past couple of weeks. And as we know, things are constantly evolving and changing. So okay.
Oh,
yeah.
I was just going to say that, periodically fairly frequently, I just go into the MLS and just select Fairfax County and just look at the entire number of properties in Fairfax County. And in, 2018, 2019 on, on the lower end, you might see 18 or 1900. And then on a Friday evening in the spring, you might see 2400. The last time I looked, there were about 850.
Mhm.
So inventory is just so radically low still.
Yeah, I agree.
Take
I
care
agree.
of
And
that.
I think that's what's driving a lot of this as well, is our inventory is super low. And then I think people have kind of adjusted to that one, either rate, they're more comfortable because rates are not continuing to rise. They've come down some, and there's the expectation that rates can continue to improve. So, so I think that's what's helped open it up also. So we'll see. All right. Well, thank you guys for all this feedback. I hope you found this useful for you, and working with your clients. If you need anything, or if there's anything we can do to help, just let us know, and have a great rest of the day.
Thanks, everybody.
Thank you.
All right. Take care.
Here.